One of India's most successful investors, Dolly Khanna's story should make every housewife in India sit up and think, why not me? Because let's be honest, how many of us think our dreams expire once we settle into the rhythm of family life? The truth is, Dolly proved that the walls of a kitchen can be the very foundation for building a financial empire. Dolly Khanna doesn't give interviews, doesn't appear at conferences, and most people wouldn't even recognize her if she walked past them on Marine Drive. That's why she is called the stealth investor of India. And today, we're decoding her secrets. But who exactly is Dolly Khanna? Here's the twist. Dolly herself isn't even the one picking stocks. It's her husband, Rajeev Khanna, an IIT Madras alumnus and former ice cream tycoon who founded Quality Milk Foods. And after selling it to Hindustan Unilever in 1995, he turned his passion to investing. Dolly's first rule of investing is simple. She invests in companies whose products she personally uses and admires. Many investors find comfort and confidence in investing in companies whose products they use regularly. This approach stems from the idea that familiarity breeds understanding. When you're the consumer of a company's products, you have first-hand experience with their quality, value, and overall appeal. This insight can provide a valuable edge when evaluating the company's potential as an investment. This approach aligns with advice from investment guru Peter Lynch, who advocates for investing in companies whose products you understand and use. In 2011, Dolly invested in TTK Prestige. Yes, that same company that manufactures Prestige cooker and other kitchenware that our mom uses in her kitchen. Dolly invested in Unitech shares when she was looking around to buy a house in the Delhi NCR region. Again, she bought into Femcare when she saw her daughter use their cosmetic products. Follows a bottom-up approach to investing, where she emphasizes on understanding the business model of a company by asking a few questions like, what does the company sell? Who are their customers? How do they make money? What could go wrong? If she can't answer all 4 questions in under a minute, she doesn't care how hot the sector is and avoids investing in that company. Khanna prefers investing in B2C businesses with a large and growing customer base. B2C means business to consumer. These companies generally sell directly to individual consumers for their own personal use. The core of the B2C model lies in creating a direct relationship with the end customer. These companies have a faster growth potential and stronger control over pricing compared to their B2B counterparts. Dolly Khanna doesn't just pick companies, she picks massive, economy-shaping long-term themes that pull entire industries upward. Chemical boom, she was there early. FMCG revival, bought Imami and Tata Consumer at the right time. Housing revival, looked into companies like Rain Industries. Khanna bought Firamalay Chemicals in 2014 at 50 to 60 rupee levels. This move aligned with the specialty chemicals boom, particularly as China's environmental constraints gave Indian producers an edge. Dolly's husband Rajeev Khanna, who managed her portfolio, had a chemical engineering background from IIT Madras, so he was well versed with the chemicals industry. The stock went all the way to 1,200 rupees by 2017. That's more than 20x in 3 years. Dolly looks into a few financial metrics before investing in the shares of a company. 1. Sales growth greater than 15%. Dolly wants steady, predictable expansion, proof that the business has a growing demand base. 15% year-on-year sales growth signals strong product-market fit without hype-driven volatility. Profit growth greater than 20%. Profits growing faster than sales, at least 20% annually. This means margins are improving, costs are under control, and the company is becoming more efficient. 3. ROCE greater than 15%. ROCE measures how effectively a company turns every rupee of capital into profit. 4. Promoter holding greater than 50%. Promoters owning at least half the company. High promoter ownership in the company aligns their interests with shareholders. 5. Interest coverage ratio less than 4. Many people think higher is safer, but Dolly sees a ratio under 4 as a sign of optimal leverage. Enough debt to fuel growth, but not enough to threaten survival. Too high a ratio might mean the business isn't using cheap capital to scale efficiently. 6. Market capitalization to sales ratio less than 1. This is the ratio Dolly uses to find undervalued companies. If the market values a company at less than 1 year's revenue, there's a good chance it's undervalued